Now that SoFi's crossed $16 per share, increasing over 100% over the past couple of months alone, many are now starting to wonder whether SoFi is starting to become overvalued. And if you ask many bulls, the answer is going to be a resounding no. But earlier this week, we got a new interview with SoFi's biggest bear, a man who, after increasing his price target a couple of times, still has a $5 price target on SoFi. And in this video, we're going to be taking a look at his justification for this price target and breaking it down step by step. Let's jump right in. So this is, of course, Mr. David Cavrini of Wedbush. And while SoFi has several bears, I think David has been one of the most vocal around his justification for this now $5 price target. And that was after raising it a couple of times. And this interview piqued my interest. I was tagged in it on X. It was done on Yahoo Finance a couple of days ago, where they were talking about a number of different names, mainly in Buy Now, Pay Later. He was talking about a firm, which he covers, and a couple of others. But he was asked about SoFi and he presented some arguments, and I want to break it down in this video. Now, just to preface, this was about halfway through the interview where he was asked about SoFi and Lending Club specifically. And in the end, it sort of made me laugh because, to the commentator's credit, he did highlight that SoFi is the only sell rating that David has on, whereas everything else he either has a hold or a buy on. So let's go ahead and play this clip.
David, another name I want to get your take on, because you only have one underperform in your coverage universe, David. It's just one lonely cell sitting there, and that is SoFi, which has enjoyed, it's a nice move this year. It's up around 60%. Why do you remain bearish on SoFi, David?
Yeah, so SoFi, that's our paired trade with Lending Club, and Lending Club has actually outperformed SoFi when you look at the year-to-date figures. So when you look at the business model of SoFi versus Lending Club, they're actually quite similar in terms of the FICO range that they are targeting for borrowers, and the credit quality has been similar. But when you look at the valuation discrepancy between Lending Club and SoFi, it's too wide to ignore. So that's when I keep the underperform on SoFi and keep the outperform on Lending Club. But I'll give SoFi credit that they have been right in the sweet spot of this kind of fintech rebound that we've seen this year, and they've been benefiting. But if it weren't for their valuation discrepancy with Lending Club, we would be more favorable towards SoFi.
Okay, so just to summarize a couple of key points there, he did highlight that SoFi is a pair trade with Lending Club. He said that Lending Club has outperformed SoFi. This is true from a stock performance year to date. He claims that SoFi and Lending Club are similar, and specifically, he highlights the FICO scores for borrowers and the credit quality. So he's focusing just on the lending segment, and he thinks Lending Club is very much undervalued relative to SoFi. Now, he claims the main reason he is underperformed on SoFi, he basically has a sell rating on it, is because they are more overvalued than Lending Club. So let's first take a look at the performance. And yes, Lending Club has done better on a year-to-date basis. Year-to-date, Lending Club is up 83%, whereas SoFi is only up 65%. But if you go back over the last 6 months, SoFi actually beats out Lending Club because the stock has appreciated over the past couple of months at a very much faster rate in catching up. And if you keep going on this trend, I mean, there's a very strong case to be made that SoFi is actually going to be higher than Lending Club in 2025. But of course, the market has a mind of its own, so I'm not going to go there. I do, however, want to highlight the fact that he says that SoFi and Lending Club are similar, because this is cherry picking, if you ask me. Yes, they're similar in some ways, but in the ways that they're not similar is the reason why investors are buying them, right? Because SoFi has so many other aspects that Lending Club doesn't have. SoFi is not just a lender. They have their financial services segment growing at over 80% year over year. They have their technology platform that differentiates them. They have so many more irons in the fire in terms of initiatives and product launches that essentially justify a lot of the growth rates that are associated with it. So yes, they are similar in many ways, but in many ways they're not. And this is an argument that many people use with SoFi to cherry pick data. I mean, I saw it last year where people were saying, hey, SoFi and Robinhood are direct competitors. Yeah, sure. In the brokerage side, they are, but SoFi has all of these other aspects. SoFi and Lending Club are direct competitors. Probably in the lending segment, they are for personal loans, but SoFi has so many other aspects of their business. And so it's really difficult to have a true competitor to SoFi because of their mission statement, because their mission is to be a one-stop shop for everybody's financial needs. And that includes a brokerage side, that includes a home loan, a personal loan, that includes so many different aspects. It includes credit scores, taxes, insurance later on, why not? And as a result of that versatility, many people then compare slivers of SoFi with other businesses. In this case, the lending segment with Lending Club. And yeah, let's just compare them for a second. So here I have a split screen with Lending Club on one side and SoFi on the other. And you can see the year-to-date performance. Lending Club is up 83% and SoFi is up 65%. And I don't want to spend too much time here. We're just going to take a glance. You can see the market cap difference is something that immediately stood out to me. Lending Club is 1/10 the size of SoFi. It's about 1.7 billion compared to SoFi's 17 billion. And if we just look at the latest quarter financials for both of these businesses, in September, Lending Club did 300 million compared to SoFi's 700 million. So yeah, you could make an argument to say, hey, from a price to sales perspective, Lending Club is definitely undervalued. Even from a price to earnings perspective, Lending Club's price to earnings is 34 versus SoFi's price to earnings is 90. And so you can definitely make the argument that Lending Club is undervalued relative to SoFi, depending on what metrics you're choosing to pick from. And one thing that I did find interesting is I also looked at the annual basis, but this I think only took into consideration 2023, where Lending Club was down with all of their metrics, where I'm sure in 2024 they've actually started to bounce back in a big way. So we'll just take a look at both, right? Because annually SoFi was up in 2023, and every single quarter since then, SoFi's been up and consistently profitable as well. So both of these businesses are profitable. They're both growing revenue and they're both growing net income. In terms of the balance sheet, again, if we just look at the latest quarter, you can see Lending Club has about $1 billion in cash. SoFi has 2.3 billion. And then the assets, SoFi has about 3 times the amount of assets that Lending Club does. So there are similarities in the businesses. And yes, you could definitely make a case for Lending Club to be more undervalued relative to SoFi because of the market cap being where it is at 1.7 billion, even though Lending Club is doing, over $1 billion a year in terms of annualized revenue. So it could be very undervalued. But again, the growth rates and the prospects are also something major that investors take into account. And let's just put this aside for a second, okay? Let's just, for the sake of this video, say that they are similar businesses. For the record, I don't think that they are. It's not apples to apples because SoFi has so many other segments of their business, like I just mentioned, financial services and technology platform and others. But let's just say, for the sake of the argument, that they are very similar and they are apples to apples in the lending segment. Great. You're admitting that they're similar businesses. Then why do you have a pair trade on them? Because a pair trade is when you go short one name and long another name. So an example of this would be if I believe that Bitcoin is going to be a new store of value because it's a digital gold, then I would buy Bitcoin, go long, and then I would go short gold, essentially bet against gold, betting that it's going to go down. So essentially, I'm saying I think Bitcoin is going to rise and I think gold is going to fall. And just thinking this through with logic, this is where I find a flaw because David is not saying he is bullish on both SoFi and Lending Club, and that Lending Club is just going to increase at a faster pace because it's more undervalued. His argument is essentially saying that he is bearish on SoFi because it's more overvalued to Lending Club. And here's where we see a flaw in the logic, because the first flaw, if we just take a step back, is that it's not apples to oranges. SoFi is a much more diverse business. So number one. Number two, if he's using the logic to say both Lending Club and SoFi are similar in terms of the FICO scores and the credit quality of their borrowers, then if I'm reading between the lines, what I'm seeing is that the lending space is just fine on a macro level because borrowers and credit quality is not going to lead to delinquencies across the board. Like if we were going into a massive recession, for example, both would fall. But we're not. So essentially, both are going to rise, is what that tells me. But he's not saying that, right? He's saying the macro is fine, but then he's against SoFi as an individual names, which again, to me, by deduction, it must mean that if the macro is fine, if the space is going to increase, then there must be something wrong with SoFi as an individual name in that space. Like if SoFi is just burning money on stupid initiatives, or if they're not returning to shareholders, or whatever it may be, SoFi specifically is the problem because the space is actually growing. And that's also totally fine, right? If he came out and he said, hey, I'm bearish on SoFi because I think that Anthony Noto is not the right leader, because I think XYZ, because I think that they're spending way too much money on sports and spending way too much money on sales and marketing, whatever the case may be. If it's a case that's isolated to SoFi specifically, that's also fine. But he is saying that he is more bullish on Lending Club because of the valuation, although he is essentially bullish on the space because they're very similar businesses. Both statements cannot be true. If the businesses are similar in the same space, then you're generally bullish on the space. You think the space is going to increase. It's like me saying I'm bullish on Bitcoin, and so I'm buying Marathon, but I'm going short CleanSpark. Those are both Bitcoin miners, the number 1 and the number 2 Bitcoin miners. unless there's something fundamentally wrong with the company that I'm going short, I would not be short because I'm bullish. I'm long the space. I'm long Bitcoin, right? And so here, to me, he's saying something is fundamentally broken with SoFi, and that's why he's short, except he doesn't come out and say that. He just says it's a valuation. And that's the part that doesn't make sense. And the other funny thing here is that, Chris on X actually did the math after this interview came out. And when Cavarini put on this pair trade note, it was the literal bottom of SoFi stock. And I had a good little laugh, as I was reading this in preparation for this video. So I'll read out this tweet that Chris had. He said, quote, David Cavarini didn't put on this pair trade on December 31st, 2023. So it's not like a, start of year, end of year, let's see how it goes type of thing. He put it on May 15th, 2023. And on May 15th, when he put out that note saying that he's doing a pair trade, his price target for SoFi was $2.50 when the stock was trading for $4.77. And as we know, in retrospect, SoFi bottomed at around $4.5. So he was about 25 to 30 cents away from the bottom of the stock. Now, when he made that call, Lending Club was at $7.44. And so in his example here, Chris uses $1,000. So you go short $1,000 of SoFi and you buy $1,000 of Lending Club. That Lending Club position is over double, 112% gain. However, that SoFi short position is a 233% loss. So overall, you would have lost money on this successful pair trade because it's exactly what I'm saying. You essentially have both of these stocks that are going up. They're just going up at different rates. And so that's really the flaw in the logic of using a pair trade, because you could very easily say, hey, SoFi is a hold and Lending Club is more undervalued, so Lending Club is a buy. That's fine. But he's saying SoFi is a sell because it's undervalued relative to Lending Club. And the issue is that both of them are going up because he's saying they're very similar in the space. So that's my whole thing, right? Like that's the part that I take issue with, because generally speaking, you only put on a pair trade on two things that are the opposite to capitalize on the price movement. So an example that I used earlier was Bitcoin and gold. If I go long Bitcoin, I'm going to go short gold. Or if I go long the US dollar, I'm going to go short the euro. Or if I go long Tesla, I'm going to go short GM. Or if I go long Coca-Cola, I'm going to go short Pepsi. But in the case of Lending Club and SoFi, both of them are increasing. So I don't understand why you would go short one when you agree that both stocks are fundamentally very similar in how they drive revenue. If you're saying, hey, they both do high FICO scores, they both do good credit quality, and so you have two contradictory statements. Now, if it was like SoFi and somebody who did maybe 500 FICOs, then you could have a solid argument because it's a different scenario. You can say, oh, well, SoFi does 700 FICOs and XYZ does 500 FICOs. Therefore, I'm going long SoFi and short the other one because if we get into like a delinquency situation, this other company is going to be hurt much more relative to SoFi. Great, I understand that. But if you're saying the FICO situation is exactly the same for both of these companies, then why the hell are you short one of them? So anyways, that's my whole spiel. I found it funny more than anything because he's had to raise his price target consistently. And I think with the rate that SoFi is going, he's going to have to raise his price target over the next several months as well, especially relative to Lending Club. I'm not saying Lending Club is a bad company. I'm just saying that the premise for him to put on this trade is a broken premise because he's agreeing that the levers are the same, yet he's thinking that the result is going to be something different, which I don't understand that at all. But let me know if there's a flaw in my logic in terms of how you see this. If I'm reacting to this clip and there's something that I'm saying that's incorrect here, let me know. For right now, thank you so much for watching, and I'll see you in the next one.